Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why attorney CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's attorney CPA Joe Cordell.
Welcome to another episode of ElderTalk. This week, we're going to be talking with Peter Lazaroff. Now, many of you remember Peter. He's Chief Investment Officer for Plancorp. Plancorp is a financial advisory firm. They offer advice, especially to people who are a little further along in their career. So we know here that many of you are above 60. So we wanted to have somebody on who has a lot of clients who are at that stage of their life. Because let's face it, your time horizon's different, your priorities are different, and your plan will be different. So we want to have on somebody who can speak to your particular needs. And we thought, who better to have, Jill, than to have Peter Lazaroff back.
Yes, and by the way, he just published his first book last year, Making Money Simple. Congratulations on that. And I got to ask, is there another book in the works?
I am probably going to have to negotiate that with my wife. But I do always tell people it's my first book. And so that does maybe imply that there are more down the pike. It's more honing in on the topic that I'd like to focus on next time. But I think I will require at least a 5-year breather before going at it again.
So now where can people get a copy of this book?
Amazon is where it's cheapest. You can still find it in bookstores depending on where you live and what demand at that bookstore has been like.
Barnes and Noble? Or?
Yeah, Barnes and Noble. It has been there. I know the day it came out in St. Louis, I went to Barnes and Noble and took my kids, and that was cool to see it on the shelf for sure. But Amazon's where it's cheapest, so I would say that's the easiest place to go.
So this is Making Money Simple is the name of the book. And also Peter has his writing has appeared in Forbes, Wall Street Journal. So many of you may have come across his articles and comments before in interviews and whatnot. So Peter, let's hone in on people who are, let's say that they're just across that threshold line where they're either very close or they're just over 60. They're in the middle of this coronavirus. There's lots of uncertainty. They've not left their job yet, we'll assume. And they had previously, if you had asked them in the 1st of January of this year, they would have said, oh, yeah, I'm going to retire, say, in a year or 2 years. Now they're wondering, is that feasible? Tell me what the conversation would be like if somebody like that came into your office and sat down and said, I really need to decide, am I going to retire as was my original plan, or should I think about an alternative?
Well, if someone is coming to us as an advisor for the first time in their lives, they've never worked with an advisor before, the question really becomes, can you retire? So not should you, but is it even feasible? And I think that a lot of people, the trigger point for working with an advisor if they never have before, or making a change in advisor, is like 10 years or less before retirement, in part because you realize, hey, this is real. And for some people, they're just tired of working, or maybe retirement is different than a 30-year vacation. It's, I just want to do what I want with my time.
Yeah.
So not so much, I'm not going to go to the office, I'm not going to take on any projects, I'm not going to consult, but I'm ready to be the owner of my time in its fullest. And that's really all money is to begin with. It's just a tool that you exchange for time, effectively.
Yeah.
And so I think that if someone's coming and they're trying to figure out, can I retire next year or in the next 5 years or next 10 years, typically it's assess where you are right now situation. Where are you trying to go? So what does retirement look like for you? What do you want to spend? And is it possible to achieve those goals as it stands? And if not, what are the things we need to do? Because I think one of the most important things about financial planning is if you were a commercial air pilot and you sat in a seat and you didn't know what city you were in or what city you were flying to, there's nothing you can do. But when you know where you're going, you make a flight plan. It's based on weather conditions. It's based on air traffic. It's based on the weight of your plane and how many people are on it and the weight distribution of that. And you make changes. So I think a lot of the process is exactly that, a process. It's not like a one-time deliverable that you give to somebody. And I do think that a lot of people want that from an advisor. They just want to bound up plan. They want it in a nice binder or a piece of paper, and they want a one-time fee. I want to work with an advisor once, but financial planning is a process, not a deliverable in that sense.
Right.
Yeah. That's very similar to a conversation we had recently with the attorneys at TuckerAllen, is that when you think about estate planning, it's a relationship. It's a relationship over decades, because things will change, and your life at this stage is going through continual change, arguably greater change, maybe changes that are less controllable than perhaps those that occurred when you were 30 to 50. Mm-hmm. And it's important to have somebody to whom you can go regularly, circle back periodically, not monthly, but maybe every year. And I would think the same thing would certainly exist, maybe even for stronger reasons, when you are trying to develop a plan to walk through that same period of time.
Right.
Well, especially if you want to enjoy your life, unless taxes and estate planning and investments are what you're passionate about. If you want to be spending your time elsewhere, you're likely to hire a professional, just like I hire someone to mow my lawn. I can mow my lawn. I'm not going to kill it, but it's definitely going to look better when somebody else does it. And I'm never going to have to mow the lawn on the weekend, which is important to me at this stage in life and will probably always be important to me for the rest of life now. Mm-hmm. The thing about when you're going through the process, when you are trying to think of finding someone that you trust as you enter the retirement age, or as you enter a period of time as you're aging and your kids are getting older, it's not fun to think about, but there is cognitive decline over time. And you have to make good choices while you're younger, so that if you're in your 70s, 80s, 90s, you remember that you pick somebody you trust, and you didn't just pick them right away. Maybe you interview multiple people.
Did your homework, yeah.
Yeah, you know that you made a good decision. And what's even more important oftentimes is that you tell the kids, if you have kids, why you made that decision, so that there is this trusted resource later in life when you don't recognize that you're going through cognitive decline. And it's not exactly something fun that anybody wants to talk about, but it's a very, very real phenomena, and probably one of the most important reasons that someone should have an advisor as they're entering into retirement, particularly if they haven't had one in the past. Now, another common thing that we're seeing is that baby boomers make up the biggest population of advisors right now, but they're all retiring. So you may have been working with somebody your entire life, but as they retire, who is stepping up after them? And it's the same thing with attorneys. You mentioned estate attorneys, someone who knows your situation. A partner might retire, and you would hope that you understand who is going to be there when you actually need them.
To step in, right?
Continuity is huge. And in both of these, on both of these subjects, both with respect to money and financial planning. And your point about cognitive decline, it probably isn't a popular subject. We've talked about it from time to time here on this show, but it makes it imperative that you select people, key professionals in your life that you can trust, and that the time will come, maybe not, but there's a good chance the time will come when you'll become increasingly reliant on these people, when perhaps their judgment regarding what you would want will become more influential than yours, and that their decision-making will, over time, perhaps dominate what's done regarding your estate plan as well as your financial. And that's as it should be, because that's what the circumstances require in that scenario. And then if it never occurs, if you never have that sort of decline in terms of your capacity to run your life, great. You still have these great professionals that you've continued to work with. So you raise a couple points. You do need to be sure that whoever you're using will probably outlive you.
Yeah.
And you need to be reasonably confident of that. And a law firm that's pretty established will be able to point to you, oh, yeah, we have these other attorneys who, yes, there will be continuity of care, so to speak. And similarly with a financial planning firm. So what do you think about this thing called a 4% rule? And let me tell a little bit about it before you answer it, and then you can tell more. But when I ask this question, I'm simply wondering, how much money do you as a professional think a person must have for a given level of income? So if somebody's going to retire and they're used to living on $50,000 a year, and they still want to have $50,000 a year, I've heard about this 4% rule that is supposed to be some sort of benchmark to tell you if you're going to have enough money to last your lifetime. Can you explain and talk about that?
Absolutely. So with all financial rules of thumb, there are exceptions. And people often say they call it personal finance because it's personal, which makes perfect sense. However, when most people ask me how much will I need to retire if I spend this much, as a back of the envelope number, I'll use the 4% rule. Sure, why not? I do think it's dated and I do think it's flawed.
I've heard that.
Yeah, the 4% rule, the dated part of it comes from the fact that fixed income or your bond piece of your portfolio doesn't earn income the way it did in the 80s and the 90s and even in the early 2000s. Your interest rates are historically low. They're near zero. Right. And so the 4% rule is really reliant on your portfolio earning a certain amount of yield or total return. And just to be clear, total return is price appreciation plus yield. And in a world where yields on bonds and cash products are so low, you have to think more total return terms than yield. And when you're thinking more total return terms, that means that the stock market's down some years, even the bond market's down some years, although less frequently. That means that relying on some set percentage can be dangerous. So that's what makes it dated. And it's really just the starting point of where income-producing investments start today. But the other piece is just that everyone's different. So if you're going to live to 120, 4% rule is not going to work. Most people don't live to 120. But 50% of all married couples age 65, half of them make it to age 95.
Right.
And so, that's the real issue is how long are you going to live? How much flexibility do you want? And costs don't go down in retirement. They usually stay the same, whether it's because in those early years you're traveling more or eating out more, spending more time with grandkids or doing activities. And then as you get older, the healthcare costs kick in. They go up and they replace all those other expenses such that it's never like you actually
having to go into a long-term care facility. I mean, if we had a crystal ball and knew all of these things, but we don't.
Tell me the day you're going to die and I can do some amazing planning for you. But, no one wants to do that. And at the same time, it isn't rational to have a plan that has you spend every penny. You want to pass away. If we're talking about such morbid things, you want to pass away with some money in your pocket. It's not rational to plan to spend down to
die
penny.
broke, as the one book says.
And there have been stories of billionaires who went for that goal, and including someone in the news recently who achieved that goal, but now he is broke, and so it's why
and still alive.
Right. Yeah. And so
who is this? Do you remember?
It's in a Forbes story.
But it was a billionaire.
I definitely can send the link to you later.
That's
it's a
curious.
Forbes guy.
And there is an assumption made in this 4%. I think it's like 25 years. And of course, this was developed at a time when it wasn't common for people to be alive 30, 35 years in retirement. But still, if somebody is going to work till at least 65 and maybe 70, that might be safe. That's 80, 95 years old. If you're 70, 65, you're 85. But as you point out, you could very well outlive that number. But another thing that people need to realize is that if you go with the 4% rule, it means you're taking 4% out of your sum, your lump sum each year. If you have a market go down during that period of time, then you still just take 4%. So it means that if you had taken a withdrawal during the early part of this year, you might have been taking just 2/3 or so of what you normally would. So while this thing does have some charm about it, because it easily will get you 25 years or so, it does mean, though, that as the financial waters or the markets go up and down, the amount of money you have available at that time will go up and down because it's 4%, whatever the number is at that stage. So your rent is going to be fixed. Maybe if you're in a long-term care facility, if you're in independent living, then that's going to be fixed. So a lot of your costs you can't manipulate. So that's a problem with the 4% rule if you're going to stick to not taking out any more in a given year.
And what do you recommend instead?
Well, what I recommend instead is difficult to achieve on your own in terms of planning. So I will just explain a little bit of a process that we use more just for an educational sense and context, and then maybe give a shorthanded way of doing it. But you look at how much you want to spend each given year. You assume that amount is going to appreciate the amount you spend by inflation, whether you assume it's historical inflation at 3% or you say it's 2% because inflation isn't that high now, whatever. You bake in the one-time costs, so maybe you're paying for kids' weddings or grandkids' college or new cars X amount of years that fall outside of this annual expenditure line. And then you take returns and you say, what does a portfolio of stocks and bonds earn and what is the wide range of outcomes? And what most financial planners will do is they'll run something called a Monte Carlo scenario where it generates 1,000 or 5,000 or 10,000 different outcomes, and it gives you a range of outcomes. It just paints a more realistic picture of what the possibilities are. Now no one's going to do that at home unless you're really good at Excel at home and you have special software. But there are some things you can do shorthanded at a Schwab or at a Vanguard that will allow you to use an online calculator, for lack of a better word, to sort of calculate what's possible. I suppose you can also go, I have a unique URL to something called brightplan.com/simple where you can get 3 free months of and you can build out retirement goals, or it's goal-specific planning. And I was involved with the creation of that. It's actually a corporate financial wellness offering, but when you go to that URL, you get 3 months for free because it's the same URL that's in my book. And so certainly if you want to map out a goal for retirement and then cancel the subscription, I'm not going to have any problem with that.
This model that you talk about is, and it's simple in its conception, meaning that you sit down, you look at the amount of money you want per year, you adjust it for inflation, you throw in special occasion costs, what those might be, and those can be any number of things, and then you look to see what the market will require in order to deliver that level of income.
Sure. The challenge, though, is that the market doesn't provide the same return year in, year out. So if you assume, let's say you need a 6.5% return to achieve all these goals, well, the market, you will have likely arrived at that number assuming that the market is compounding at an even 6.5 each and every year. Where in reality, in a year when the market lost 20%, 6.5 wouldn't recover it the next year. You'd need to earn 40% to recover the 20% loss.
And you would really want then to not take out that larger amount. So if it's a fixed amount like $50,000 a year and the market declines by a third, it really punishes your recovery. If you, rather than taking 2/3 of the 50 out, which is what you should take, you say, well, gee, I need the 50. So you take the 50 out. It really makes it difficult for you to get back on your track of accumulation, isn't it?
That's right. And even more challenging is if you don't have the sophistication of software to back you. It's one thing to make these withdrawals when you do this type of planning, and then what you're going for at the end is to have, say, a 95% chance that I don't run out of money at age 95. That's kind of what you're looking for. Not everybody achieves it. Maybe they achieve 70%, and you say, well, all that means is that 30% of the time in this 10,000 scenarios I ran, you had to make a tweak to your financial plan, whether that was work longer, spend less, save more. If you're already in retirement, you can only spend less at that stage or go back to work. But that's really what the process of planning looks like, is you try to put in every conceivable expenditure you have. By running 10,000 scenarios, you don't have to worry about when the next recession is. You don't need to worry about when and why. All you have to do is just acknowledge it. Downturns happen, and they're going to happen with a similar magnitude and frequency as they have in the past. And so rather than trying to predict downturns and adjust your portfolio accordingly, you just plan on them. And so it's actually quite a nice way to approach uncertainty, because the only rational way to make decisions about an uncertain future is probability. So you work with an advisor, you find a probability of success, helps navigate some of those decisions.
Peter, say for instance you have a client and the client is about to turn 55, and this client has had this goal of retiring early at the age of 55. And they're going to turn 55, in the next couple of months. And their portfolio looks pretty good, but we're amid a pandemic. What would you recommend to that client? I mean, would you say, wait a minute, let's put on the brakes because there's so much economic uncertainty, or move forward with your plan?
So a lot of it would depend on, have we built a plan for them? So if we go through this planning process, there will be a mathematically objective opinion where, sure, you want to stop working now. Model says it's fine. The model says you haven't really changed your range of potential outcomes. The more broad stroke advice, if you show up and you don't have a plan in place and you're not going to let us build a plan, and you're ultimately trying to figure out, does it make sense? We'd made the point earlier where it's best not to draw on your portfolio while it's down in the early years of retirement. Most people in finance will call this something like sequence of return risk, where if you draw on your portfolio while it's down in earlier years, you're permanently impairing the lifetime value of your portfolio because
Yeah.
you draw down on it when it's lower.
Yeah, the math on that is huge.
Wow.
Yeah. And so if you're 55 and you want to stop retiring, the first question I might ask is why? And the second question I might ask is, what do you plan to do? Because people who retire may not actually retire. And that really, circling way back to the beginning of the conversation, is if you are planning on taking a 30 or 40-year vacation effectively, you really have to be careful. But if you're open to opportunities and you think that you might do a little something here or there, the conversation is quite different.
You mean like a gig economy or something part-time or?
Sure. I mean, I think if you're planning to support a $150,000 income, you can't go drive for Uber. But at $50,000 you can. But you have to bake in the fact that you're going to have to replace your car. But yes, the gig economy is a great example. Perhaps you used to be a manager of some sort of business and you think you can do consulting work or freelance work. Perhaps you just want to take a role in your field, but with less responsibility because you don't want to have to be responsible for other people's time. Again, it's having control over your time, and you reach that point. I like to think of it more as you've reached the point of financial independence as opposed to retiring.
Yeah, that's a much better phrase. So that when you talk about that, Jill, a guy or gal who's 55 and they've had this fantasy, and that fantasy may have really motivated them for decades. It's just as motivating, I think, for them to be what the phrase you use, financially independent.
Yeah, you have the
Right.
choice to work or the choice to do whatever you want. If you are really grinding at your job, and people who want to retire at 55 often were very hard workers.
I would think so.
Yeah, and you burn out. And it could be that you just need a year to catch your breath. Think about how you want to spend the rest of your life. And if you've been a hard worker and you're successful, people will approach you about helping them with unique opportunities. And it's pretty common for us to see with our clients that they do enter a second act career, as we'll sometimes call it, where you are doing something similar, you're using your talents. We'll see physicians, for example, go into an area where they can use their medical knowledge to help something more operational in business skills that they never got to use in their practice. Or similarly, you'll see someone who is an executive who really just wants to mentor. They don't want to be anybody's manager, but they want to help guide people. And so you can even see like a bank president go into a financial advisory role where they don't actually want to be the advisor. They just want to make the introductions and go to lunches with people and play golf. And that sounds like a nice life, and someone's going to pay you for that. And so
it pays well, too.
Right, so it comes back
That's
to
not a bad gig.
Yeah, well, I don't think they hand those out to anybody who wants them. But if you can get a gig that makes you happy, that is a little bit of what, in my experience, people are looking for at age 55. If your goal is to retire at age 55 and you're in your 30s, well, now you're talking about cutting back your lifestyle so substantially that retiring at 55 isn't a big hurdle because you had to spend so little in your early years to save enough to get there that spending little in retirement doesn't feel like that big of a sacrifice. But if you are used to living a lifestyle that would require cutting back, I would challenge most people to how hard that is because, for one, most people underestimate their expenses. I have only met one person in all my years advising clients who actually knew what they spent on a monthly basis. And that includes people who had these detailed budget spreadsheets and they could hand over. Everyone underestimates expenses. The other piece of that is that if you do have to cut expenses, I always talk about lifestyle creep. If we put our hands into a bowl of water and we start heating it up, we're not going to really notice that it's getting hotter until it burns us. Because we really adapt to change. It's a very human thing. We adapt to novelty. We adapt to change very well when it's minimal. But if we take our warm hand and dunk it into ice water, that hurts. And that is about the sensation you have when you have to cut back expenses in retirement. Because you've been working your whole life and you've been thinking, I'm going to retire. And especially if you're focused on retiring early, you are probably fantasizing retirement a little bit more than perhaps what it really is. And if you have to also take away something from what you've been fantasizing, that's really hard to do. The final thing that I'll throw out there is that having purpose is extremely important in retirement. So if you remove all the financial mistakes people make, when you retire and nobody needs you, a lot of people don't deal with that well.
And you become unimportant.
Exactly. And depending on
your self-esteem goes in the basement, depression sets in, sure.
It's really well documented how much depression there is in years 1, 2, and 3 of retirees. There's less purpose. There's less identity. If you've tied up your identity in your work, that can be a really hard thing to move on for.
Oh, yeah.
And there's less reason to get out of bed sometimes. So, you can't just say, I'm going to go to the gym and go play golf. And if you live where we do, you can only do that so many months a year. You could travel, sure, but you have to have a plan. You have to have something to do with yourself beyond just not go to your current job.
And I do think that it's oversold that your costs go down when you retire. When you see these plans developed so often by financial planners, there's this rule of thumb. I've seen it where it suggests that 1/3 of your costs of living will go down. I don't see where that happens. I mean, I think the theory is, well, you're not going to be driving to work, so you save some money on gasoline. You don't have to buy nice clothes. But I'm thinking...
But you're finding some other areas to spend that money, I would think.
And not to mention, you may still want to wear nice clothes.
Yeah.
And even if it's casual clothes can be as expensive as suits. So,
very true.
So there's just this cliche out there, this rule of thumb that I question.
People assume they'll downsize their home, and they do in square footage, but not.
It may be just as nice.
Yeah. No, it's most of you're seeing a lot of downsizing into smaller square footage, but into highly desirable areas.
Like Clayton.
That is a perfect example.
Oh, yeah.
Where the things that are getting new built are with a specific demographic in mind. And when things go on market, they sell quickly, particularly right now, just because there's more demand and there's less supply. But that'll ebb and flow. But for the most part, you underestimate those tendencies. You underestimate how much healthcare will go up. You underestimate, it's hard to know what we're going to want 5 years from now, 20 years from now. I mean, I'm not going to know what I'm going to want for dinner a week from now. How am I going to know how often I'm going to eat out 20 years from now?
So if somebody's plan then is off, and you can probably, through Plancorp, I assume you can put a specific number.
Oh, sure.
This plan is off $260,000. And then it would seem, though, that you could turn around and say, okay, how do we plug this hole? And here's one way to do it. And assume that they continue working for 10 years, maybe part-time, in some relatively low-paying position. We'll assume that gives them the latitude to find something they really like, irrespective of earning a lot of money. And I assume over 10 to 12 years, you can take say a $250,000 or $60,000 hole and fill it or plug it that would otherwise cause a plan to fail and maybe contribute meaning to their lives.
That's a good point. And there really are three big levers you pull. And I mentioned them earlier. You either work longer, you save more, or you spend less. There are other levers to pull, but those are the three levers that plug retirement gap feasibility. I would argue, though, that if it was a choice between working part-time in a job you don't want for 10 years versus working 2 more years full-time, personally, I'd choose the 2 years.
Right.
But it's different for everybody. It depends how much you hate your job. If you hate your job, you are going to get out of there as fast as you can. I think some people feel like they can't make a career shift in a meaningful manner where it's the only way out and they're happy to do anything. And sure. But if you can do something you love, then the part-time work is tremendous. And even if it's for a couple years just to ease the transition, even if you don't really need the income, it just enhances safety that much more and allows you time to develop a routine rather than just go dunking your hand into ice water.
Well, yeah, and it's good for you emotionally, I would think, too.
Mm-hmm.
So tell me how Plancorp works.
Sure.
Though we've had you on before, I don't think we ever asked this question. So y'all do financial planning.
Yes.
Tell me what the process is.
Well, so we work with individuals in 44 states. And since we're talking about the near retiree in this case, let's picture someone who's 10 years or less from retirement. They'll come to us. Oftentimes, the first interaction is what we call a discovery meeting. First interaction is often a phone call to get to know you for 15, 20 minutes. But the first real meeting, what we'll do is we'll build you a first draft of your financial plan. Part of the reason we do that is so that we can get to know you better and understand, is this someone that we can actually help? And then similarly, you, the consumer, can decide, hey, are these people I'd really want to work with? Is what they're offering of value? And through the process, we'll try to uncover goals, tax planning opportunities. The people 10 years from retirement or the first 10 years in retirement have unbelievable tax planning opportunities. So that's like the gold mine of it all. I'm a full believer in paying your tax bill in full, but you do not need to leave the IRS a tip. So like find these opportunities in that key kind of 10 years before and 10 years after window. And so what we'll do is we'll outline here all the cash outflows that you're going to have over the next 20, 30, 45, 50 years, out to age 95. What are the assets you have today? What is coming in? What's going out? How long are you going to work? So there's three main levers: how long you work, how much you save, how much you're going to spend. Those are the main three, but there are others. And then we run the 1,000 scenarios and say, hey, 90% of the time this looks good, but today we heard this adjustment and this adjustment. And we review this plan once a year, once you become a client, and it's all about aligning the investments, proactively taking advantage of the tax planning opportunities, making sure estate plan documents are up to date. I feel like you should review your estate documents at least every other year. And right now, we're not that far off from potentially seeing large changes to estate plan liabilities. So today, you need to have over $20 million to have a federal estate tax liability. Well, what if you have $5 million today and the exemption drops? What are you going to do about it? Have you talked about it before? Can you proactively go out there and get money out of your estate in a way that is low cost and low risk and doesn't give up too much control? So whether that's a grantor retained annuity trust or whether it's just simple annual exclusion giving, these are all things that go through the process and talking. And the real goal is that you've worked hard to earn some comforts in life and you want to protect those comforts. And you want to do so in a way that you don't have to feel uncomfortable in the process of doing it. So if you come to us and we run our model and we say you have a 60% chance of this working, you're going to have to work a lot longer or spend a lot less, and you say no, I can't do those things, and we say, yeah, it's just not a fit. Like, if you're not going to take our advice, it's not worth paying for it. If you're in a good situation, then we start dreaming up different scenarios. Well, what if you did retire 5 years earlier? Or what if you added $10,000 to your travel budget every year? Or what if we gifted to kids this way? Or what if? Then it's just mapping out the different scenarios. And as I mentioned at the top, it's a process. It's not a deliverable. I think of the whole planning process. It's like a living, breathing document, this financial plan, that should change all the time.
So we're talking to Peter Lazaroff of Plancorp. I'm asking Peter about how they do their financial planning process, to use this kind of as an illustration for listeners, to tell you about Plancorp too, but primarily the objective is for you to get a sense of what the estate planning process or the financial planning process is like. Whenever you develop this plan and you say, okay, if this is your goal, this is what needs to happen. Does Plancorp participate in deciding what investments are going to achieve that goal?
Yes, that's actually my job. So as Chief Investment Officer, I oversee a little over $4.5 billion, and the wealth manager that you work with builds the financial plan, identifies the tax planning, the estate planning, the insurance planning type needs, and feeds my team notes about your situation and your plans so that we design a portfolio to meet your needs. Good investing, in my opinion, is boring, so there's no real magic going on. I hope I have job security after saying that, but ultimately, the investment process is more about minimizing mistakes, in exercising extreme patience when all of your instincts tell you to do otherwise. And so there's a lot of education that comes out of my team. It's not just the selection of investments or the actual purchasing and selling.
And that's why it's so important that you hire a professional.
Sure. I watch people, how they make investment decisions all the time, and I just politely nod my head. And we put a lot of time into this stuff. I'm generally more concerned about implementing a bad idea than missing out on a good one, which to me, who does research all day long, intuitively makes sense because there's not a Nobel Prize winning investment idea each and every year, nor a product that offers it. And there's not similarly a great idea every 5 years. And Warren Buffett has a great analogy where he talks about if you had a punch card with 20 slots, and every time you make an investment change, you punch one of those slots, and when your card's all punched out, that's it. That's all you get. So imagine you had a punch card with 20 slots for your whole investment horizon. Most people are way past that 20 investment changes by the time they're 10 years from retirement. I take a lot of pride in the fact that our firm wants to go slowly and use this process that emphasizes your best idea and makes you focus on all the options rather than hurry to make a change, because all investing is I would argue, a multi-decade decision. And some people will sneer at me when they're in their 70s or 80s and say, I don't have multiple decades. Well, unless you are intentionally trying to run out of money in your lifetime, your money's going to outlive you. And that means that your money has a horizon beyond your life. So generally speaking, I really do believe everyone has a multiple decade horizon. And really basic financial theory tends to play out very, very well if you give it time to work.
Well, when you think about investment, though, you think about, I assume, a focus on the stock market, whether it's S&P or an index, maybe if you're a little bolder, NASDAQ or something. But don't you feel competition from these robo-investment programs where there seems to be a trend now where there are these online automated processes that I assume all they do is just invest in indexes?
That's right.
How do you distinguish yourself as a firm when you have these services that are offering such low-cost investment programs?
So a great question. So what you've effectively laid out is how commoditized investment management has become. And there's a lot of people doing investment advice, providing investment advice, who don't follow these asset allocation, low-cost, tax-efficient models that the robo-advisors provide. And then there's a lot of companies that do take a similar approach. And when you do take that approach, you wonder, what are you paying for? So I would argue what those robo-advisors charge is the cost of investment management. That's the benchmark. The way that our firm didn't even provide investment advice for the first, decade. We've been in business since 1983. All we did was financial planning for a fee. It wasn't until we introduced investing that we started merging the two together. And
do you still have that option?
Yeah, we'll do a monthly retainer where you pay a monthly fee for financial planning. It ranges between $500 a month and $700 a month, so it's not cheap. But the same reason that if you charge 1% to manage investments and get full financial planning, to your question, how do we differentiate? We believe that the financial planning piece is the most valuable piece. And if you look at the history of financial advice, it used to be that if you wanted to invest in the market, you called your broker and they'd give you a couple individual stocks to buy. And they would sell them to you and they get paid based on how much you bought or how frequently you bought. Then people realized, hey, diversification is important. So then those brokers, you'd call them up, they'd sell you a mutual fund. And the way they'd get paid is putting you in certain mutual funds. Then there was another evolution where asset allocation, or the mix of stocks and bonds, or U.S. stocks and international stocks, became important. And that's what people started providing.
Then it became, hey, we're going to those waves.
Yeah, and we've just evolved to the point where if you're paying somebody 0.5% or 1% or whatever it is, and you are not getting proactive, comprehensive financial advice, then yeah, you're paying too much. You should just go to a robo-advisor. I genuinely believe the robo-advisors are perfectly efficient for investing. Are they optimal in terms of customizing taxes? Maybe not. And if you have concerns about like environmental, social governance issues, some of them do a good job, some of them don't. But Vanguard offers one for like 0.15%. So yeah, that's really cheap. If that's all you need, I would argue there is a huge population where that is all they need. But there's also, once you have enough wealth and you have multiple goals and it's more than just a portfolio, that's when you need somebody else. And that's where you want somebody who you're never having to call them being like, hey, I read about these Roth conversions. Should I do this? No, your advisor should be telling you what the latest tax strategies are and laying them out for you in a way that is understandable and is meaningfully impactful for your life.
So then tell me how you do end up pricing this. And I get the argument. I get it that in exchange for having a thoughtful plan, a lifetime plan, as opposed to handling your transaction costs for a month or to be part of an index. That's all passive, but it's very active and analytical if you're bringing to the table, sitting down, developing a plan that's very personal, and then overseeing the investments. Is all of that included in whatever you're charging to manage these funds, and how does it vary based on somebody who may have very little money? And I wonder, is it profitable for you if they have only, say, $300,000 that you're going to be managing? Is it still profitable for you to not charge them for a plan if you don't, and they still turn their funds over to you? How's that work?
Yeah, so for our firm, for Plancorp specifically, the way that we bill, we do offer a monthly retainer. So there's a $500 a month option or a $700 a month option. That is unique, so you don't see that everywhere. the model that a lot of people offer that is the primary model that our clients use is you get billed a percentage of the assets that are being managed. So I know because we do a lot of benchmarking studies that our fees are below average, but for the first $1 million we're managing, it's 1%. For the next $2 million, it's 0.75. For the next $2 million, it's 0.6. It goes down as you're managing more money. And with that, whether you take our financial planning advice or you just have us manage the investments, that's the fee. And so you wouldn't come to us with $300,000 if you were in your 50s or 60s because you'll run out of money and we have a minimum fee of $5,000. So you'd be paying more than 1% in that scenario anyways. But I would say if you have small sums of money, I think Vanguard is a terrific option. They have like I said, a 0.15% investment only option. They have, I think, a 0.3% investment and financial guidance from a certified financial planner option. They are young kids out of college. There is a lot of turnover. It is a call center, but it was serving a population that wasn't getting served before, and it's a tremendous offering.
So then if using the $5,000 minimum, so if somebody has $500,000, that would be 1%.
Yeah.
And for that $5,000, they would get a plan. You all would prepare this life plan.
Yep.
That would be reviewed and updated from time to time.
Yep.
And then you would manage their investments. And does that mean that they could, for example, call you and ask you about, I'm thinking about investing in REITs, and I'm leaning toward REITs. What do you think? Is it that level of individuality that they would get for this 1% of this five?
Sure, to an extent.
500,000.
So the individuality would come to, I would include REITs if I thought they were a good idea. And it's not to say it couldn't be a collaborative process. However, once you have a broad-based allocation, we're not going to change it that much. And if we're going to change it, it's going to be based on my team's research, which is very rigorous. And when we talk about a portfolio change, we can spend up to 2 years identifying and testing on a portfolio change as small as something as, hey, should we add this REIT or that one? And so it's, if you are not hands-off, if you're not willing to delegate the investment management, an investment manager isn't a good fit. You'll certainly find someone who will say yes to everything you request. Those people exist. We're just not one of those people.
So you're not stock picking?
No, we're using mutual funds and exchange-traded funds, or ETFs if people know them. And occasionally we'll use something called separately managed accounts, which can own a lot of individual stocks or individual bonds, but we're not out there saying Coca-Cola is better than McDonald's or, ExxonMobil is better than BP. We're not making those delineations, but we do offering customization and approach. So we offer portfolios that just index. We offer portfolios that focus on what we call ESG, environmental, social, and governance issues. We offer portfolios that seek to outperformance over the long term that we call factor portfolios, and they emphasize value companies, small companies, profitable companies. Again, we're not stock picking.
Yeah.
We're just picking the funds that focus on those areas.
Peter, there's been so much job loss through this pandemic, and many of them are folks in their late 50s. They've been working for this company for several years and had hoped to retire at this company. Okay, how does this impact their retirement at this stage of the game?
Well, it's not good. And I'm not trying to be silly, but the best thing you can do is start looking for work, which maybe sounds overly obvious.
Right.
However, it's an opportunity to reset. So if you're in your 50s and you've been working for the same company for 10 years or 20 years for sure, but let's just say 10, a lot has changed in the job market. There may be opportunities that that weren't really job options 10 years ago. And so in all things in life, it's always best to try to keep positivity and find the silver lining. And I would say that the job market is dynamic in such a way that if you start meeting with all the people you know, and granted, it might have to be over WebEx or Zoom or a safe distance or whatever these days, but generally speaking, you might find that there's something you're really interested in. And I don't think it's too late to go back to school at 50 because people work till they're 70 now.
Well, that's
true. Now, I would
true.
say you don't want to go get a $60,000 a year education, but I don't see the problem with doing some online education, with doing some, we have a really great set of local colleges here and universities that aren't going to break your bank. I don't think it's outlandish to make that sort of move. Mm-hmm. And certainly the rate at which people are hiring freelance workers is much higher than ever. And when you're in a bad economy, companies are not looking to take on full-time hires. They would rather have a contract worker anyway. So figure out what it is that's your skill and market yourself to those companies. And now you're your own boss. And now you get to take advantage of a lot of tax planning opportunities. One quick note on the tax planning opportunities that's somewhat tangential is that your income will be lower in a year where you're laid off, which means your bracket's going to be lower. And anytime your income bracket's going to be lower, there's opportunity to take advantage of that. And so that would be the other piece to think about. All taxes are supposed to rise in 2025, regardless of who's in office. There's some, depending on who comes in office, taxes might go higher. And we're spending a lot of money as a government, so somebody has to pay for it eventually. Again, tax rise in 2025, it might be a really nice opportunity to make some lemonade out of lemons.
And on a lighter note, I cannot let you go before you share your story. It's really an interesting one about what launched your career path, and it involved a jukebox when you were very young.
Now, I haven't heard this story.
It's really interesting.
Yeah. So I even remember where it was. So my parents took my sister and I to Cafe Manhattan almost every week in Clayton, a little pizza and shake and burger place. And
I know the place.
They've changed locations since, but just right next door to where they were. And there was a jukebox. And I remember we used to play table games while waiting for the food because pizzas take a while and kids are little and impatient. And so quarters are spinning and dimes are spinning, and I want to go pick out a song on the jukebox. So I asked my dad for a quarter, and he looks me right in the eye and goes, "Is it worth your money?" And I go, "No." And he says, "Well, then it's not worth mine." And I'm maybe 7 years old at this point, and I have a 7-year-old right now, so this is very relatable. When we're there every week, so the very next week we're back, going through the same routine, playing some of these games on the table that we, spin quarters. We're playing hockey with the quarters. I say, "Dad, can I have a quarter for the jukebox?" And again, he asks, "Is it worth your money?" And this time I think I'm smart, and I say yes. And he says, "Great, go spend your own." So that's really my first distinctive money lesson. And I think that people who are parents, you are your kid's number one money teacher. Mm-hmm. You don't have to know a lot about money to just be honest about your money. I've written about allowances before. I've written about child education. There is not financial literacy courses that are widely offered, but truly the example that you set as a parent is going to be echoed by your children, which is true in a lot of things in life, but certainly with money where there's no formal education for most of us, it's in your hands as a parent. And even if your kids are adults now and they have kids, you are still setting an example for your children. So don't forget that, look, adult children don't really want your advice. However, you can show by example and
modeling.
You can model the way that, and the way that you act is the way that they'll act with their adult children one day. So the lessons really, you can take them in passively or impassively. But
so, what song did you want to play on that jukebox?
I can't remember. I actually am going to guess it was an Elvis thing, but back then when I was 7, who knows? Who knows?
So, what profession was your dad in?
My dad was a pediatrician, and my mom was a nurse practitioner. And so felt like I was going to go into a medical background.
Yeah, healthcare there.
I remember doing hospital rounds because he also was a WashU teacher as well. But main business was being a pediatrician. He's since retired, but I would do hospital rounds with him. And in medical school, they learn through the process of see one, do one, teach one, and that's how you learn. And for me, with writing, that has been my teach one. And I selfishly have been writing. I was a terrible writer in high school. I think I got a little bit better in college because I was forced to write with my major. But ultimately, this writing is what helps me understand, and it helps me formulate my ideas. And I think it's a really great exercise just for clarifying your own thoughts. But I think that probably held a lot of influence in my career in a situation where traditional classroom learning was not my strength, candidly. And I really excelled when I got into the world where the see one, teach one, do one was quite applicable. Mm-hmm.
So you were not an academic sort.
My grades weren't bad, but I did have a sister who always got straight A's. So it wasn't that. I know it wasn't that. I know what that looks like. That was not my academic experience.
So now your dad was a pediatrician through WashU?
He was a pediatrician through his own practice, ESSA Health, which maybe you're familiar with. They have a lot. He was one of the doctors who started ESSA Health.
But he taught at WashU?
Yes. Now, I don't know how those are structured, but I do know that, he wasn't a full-time professor there or a resident doc.
What was his first name?
Richard.
I think that he may have been the pediatrician for my daughters.
Well, that's basically
What
my
a small
entire
world.
St. Louis experience. It was when we were kids, much like he wouldn't give me money for the jukebox, you could not go somewhere where someone didn't walk up and he was a patient. So he actually wrote a book himself called Some Assembly Required. He wrote it the year. It's really fabulous. He wrote it the year after he retired, or his first year of retirement. Remember, it's important to have something to do when you retire. And it was sort of like a big mind dump, but in an organized fashion, of all the things that he learned and guided parents with as a pediatrician. And once I had kids myself, having a pediatrician as a father / grandfather is both helpful and terrifying, because they're judging what you're doing a little bit. But also when you're panicking, you can call dad and know that either your panic is unwarranted or, oh my gosh, let's take care of this right away.
So your dad is still living?
Oh, yeah. He's here. My mom and dad are here still in St. Louis, and they are super involved with our lives, which is great. We feel really fortunate about that. And I grew up in the St. Louis area, so being here was never part of my plan, but working for a firm that operates nationally and has offices everywhere allows me generally to travel the country in a way that's fun to be here. This is just a great place to raise a family.
Get the best of both worlds.
I can tell you that your dad has this incredible reputation, because my wife was very picky about finding a pediatrician. And once she found one, she would quote your dad like somebody from a book of the Bible. And
I still quote my dad on a lot of his pediatrician sayings, and certainly remember a lot of the go-to advice when you'd hear dad on the phone saying he's taking call and telling a kid to take a bath. I heard him tell so many parents to have their kids take a bath, when you call the doctor after hours. So now whenever something's wrong with my kid just takes a bath. That's really all they need.
it's amazing what a bath can do.
Yeah.
So just real quickly then, so you, how did you end up then with Plancorp specifically?
So I graduated in 2007 and went to work for an independent investment firm, spent about 8 years there. And when I came to Plancorp, I had been working, 85% of the clients I worked with were physicians. However, I found myself often having to call my estate attorney or my accountant to give advice. And so when I went to Plancorp, a lot of it was because I felt like my clients needed more than what I could offer them. And at Plancorp, I also saw a succession plan that was actively in place. So the 3 founding partners, who are all in their final couple of years, they only own 20% of the firm now. And the average age advisor where I am is 35 years old. And I looked around and I said, I can work with these people the rest of my career. Plus, I can not be a direct advisor myself and let someone who is good at tax and estate and insurance and investments lead the relationships while I focus on my strength, which is really investments. And I know plenty to be dangerous on the other topics. They just don't interest me as much. I'm constantly learning more about everything every day. And that's sort of the process about investing, is the more you learn, the more you realize you don't know. You do get into some esoteric stuff, but certainly is what keeps me going.
So then you have in-house these various specialists, and they participate whenever somebody comes on board as a client?
That's right. There are no books of business. Everybody's salaried. So the idea is that you have a lead wealth manager and a lead financial planner. And much like when you go to a law firm, there's like a partner and an associate. It is structured a little bit like that, and some more administrative people who act on your team. And then you have consultants. I am a consultant on advanced investing issues. Not everybody has advanced issues in the investment arena. You have CPAs who rotate around and assist with advanced tax issues. Again, not everybody has advanced tax issues. Sometimes your wealth manager can handle it. But the idea is if you're salaried, then you're helping each other out. You don't have incentives to say like, hey, roll over your 401k so I get paid more. It's not really the way it should work.
So for that 1% that somebody's paying for Plancorp, does it include access to that expertise?
You're a client of the firm. You get everybody. Now, we try, like anybody, to give access to everybody through as many different avenues as possible. So if we have 1,400 clients, I obviously can't meet with everybody, but not everybody wants to meet with me.
Yeah.
It is more a matter of trying to find, if people want me, I'm available. Am I available in the next hour? Maybe not. And I think everybody recognizes that. We're really fortunate to work with great clients and great people. We try to do stuff where we make ourselves available through like live office hours where people can get Q&A with our leadership team. And that often provides people a chance to see more than just the lead wealth manager. And earlier we talked about succession planning as an important way to identify an advisor. You don't want one person making all your investment decisions and tax decisions and estate planning decisions. I have a team of people solely focused on investing to assist the people who are already pretty knowledgeable. You got to have a deep bench, otherwise you aren't getting the latest information and the best technique and the best execution.
And I see that as really the only effective way to compete with this ever-changing online platform world in which, it's kind of a race to the bottom in terms of fees, and so things are getting close to zero. And in order for firms such as yours that are, I'll call it full-service firms, in order for you to compete, you have to offer a lot more value in these other areas.
And we have to build a lot of technology. So
you
build a lot of technology, we can serve more people with the same number of people. And we've invested as much as anybody in the country in technology. And it's not always even client-facing. A lot of it's internal. There's a lot of stuff you can buy off the shelf and plug into your firm, but we have gone out and done some fundraising and built our own software, and that's been exciting. And when I mentioned brightplan.com/simple, where you can get this free 3 months of some of these calculators, this is designed to be a corporate financial wellness benefit, but it is actually the same technology that's driving a lot of our back-end stuff that I'm referring to now. And so that's, a way for listeners, if they're looking for a way to be like, can I retire right now? You can get a free check-in based on some software that we built and helped design. It's totally exclusive to us, and certainly can get a free look at yourself.
And that's at the Brightwing, or you go say something else?
Brightplan.com/simple is the free URL. And we consider that to be our sister company that does corporate financial wellness. But it's these Fortune 500 companies that are paying for their employees to have directed access to Plancorp and our technology. Here you can go get it for free for yourself for 3 months. They will start billing you $20 a month after that. So if you don't want it, you got to cancel it.
Yeah, make sure you cancel. Yeah.
But
if you want to pay $20 a month, I worked real hard on that. So I think it's worth it. But I also understand I'm trying to give you guys the freebie. So
very interesting. Have we run out of time?
Yes, we have.
Time flies when we have great guests.
I'll just have to come back.
Yeah,
we would love that.
That's our custom. Peter Lazaroff, the son of Dr. Richard Lazaroff. For those of you listening, that his dad there's a good chance he might have been the pediatrician for your kids.
What a small world.
Yeah, it's funny. I want to tell my wife
thing
this.
That can happen here. That's right.
When I get home tonight, I want to tell my wife this. But anyway, so Peter, it's wonderful to have you. Again, he's with Plancorp. We will be back again to talk about this topic in the near future. This has been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with attorney CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.